Most people don't understand how their outgoings impact on their mortgage borrowing. Your outgoings can have a bigger impact on your mortgage amount that you can borrow as your income does, meaning you could borrow less if you've got higher outgoings, and means you may not even be able to afford that mortgage. Hi, I'm Jenny from Your Mortgage Hub, and I'm here to help those starting out or starting over with their mortgage applications by showing you what you should and shouldn't be doing when it comes to applying for a mortgage. So I had a couple of older first-time buyers come to me asking to buy their dream home, which was fantastic. Unfortunately, once I'd got all of their credit cards, their bank statements, their credit files, I could see that it just wasn't affordable for them. And it wasn't because their income didn't support it, it was because their outgoings really reduced the amount that a lender would consider lending to them. So because they were slightly older, they had some credit cards, they had childcare that they had to pay for, and they had a car loan, and it just meant that all of those outgoings just reduced that loan under. Now, a lender will build in a certain amount of expenditure they expect you to have, and they use the Office of National Statistics for this. So they will look at things like energy, groceries, fuel, sort of general outgoings, mobile phones. But as the cost of living has gone up, those outgoings have also gone up, which means that everyone's borrowing power has gone down and it has reduced. So what you could borrow a few months ago is not necessarily what you can borrow now. So that's really impacted on this couple as well. But after I ran through the figures and we got all the documents together, I could see that if they'd paid off their credit card, then potentially that loan amount would have been met, and they would be able to get that home that they wanted to. So we had a conversation and I kind of tasked them and said, look, pay off your credit cards and it's achievable for you. So one of them was actually going to get a bonus coming through within the next month or so, and they committed to using that bonus to repay the credit card. Now, the beauty of that is because they were committed to repaying it, we could then put through the application through to the lender and saying, prior to completion, this credit card will be repaid. And that boosted the affordability, and it meant that they could get that loan amount they needed to buy the home. As long as it's repaid prior to completion, the lender is happy. Your solicitor will ask to see proof of that being repaid, and it will be part of your mortgage conditions. But I'm really pleased to say we managed to get that through to offer, and they are now in the process of buying their dream home. So, as I said, sometimes repaying a credit commitment is actually better than putting down a higher deposit as such. So you could repay that credit commitment, put a lower deposit down, and actually get a higher loan amount. Now, I know that seems a little bit crazy, but it's all about how the lender works out their calculations. But it also means you've got one less outgoing each month. So that's kind of good when you move home. Also, another thing to remember is if you've recently repaid a credit commitment, such as a credit card or a loan, you do need to let your mortgage broker know, because it can take sort of up to 2 months to come off your credit file. So we can work our magic behind the scenes to show the lender that has already been repaid, and we don't need to take it into the calculations. So here are the five most common reasons as to why a lender is going to reduce the borrowing amount they're happy to lend. Number one, car and personal loans. Now, I know some people see car loans as essentials, but it actually will impact on how much you can borrow, and we have to put that into the affordability calculations. Number two, it's your credit cards or your store cards. So a lender will work out what your current balance is, and they're going to use 3% of that as your monthly payment, and they're going to put that into the affordability. So as it stands, the higher the credit card, the higher the monthly payment, the lower the loan amount they're willing to lend. Number three, childcare costs. So this could be your nursery fees, school fees, after school clubs. Now, these are all outgoings, and in some ways they're kind of essential outgoings, because without them you usually can't go to work and earn the money to get the mortgage. So they are classed as outgoings, unfortunately, and we do need to take them into account, but we also appreciate there's something that you can't really do a lot about, but it is something that will impact on your affordability. Number four, maintenance. Now, if you're receiving maintenance, we can use that as an income, and that's going to boost your affordability. But if you're paying out, it is going to be classed as an outgoing, and it will show on your bank statements, and lenders will take that into consideration when they're working out how much they're willing to lend you. Number 5, this is your credit file. Now, I know it's not really an outgoing, so it's a bit of a cheeky one I've put in there. But the way a lender will look at your credit file is if you've got, say, a credit blip or you've got bad credit, we have to go to an adverse lender, which means their interest rates are higher. Now, because a lender will use what's called a stress test to work out what they're going to lend you based on their interest rate, the higher the interest rate, potentially the lower the borrowing. So we just have to be really cautious of that. And that's why it's so important to look after your credit file when you're looking to get a mortgage. So just to recap, the 5 main things that's going to impact on the amount you can borrow with a lender for outgoings are your car and your personal loans, any credit card and store cards you have, any childcare costs such as nursery or school fees, any maintenance that you pay, and finally, also your credit card balances. So if you're wanting to know how much you can afford to borrow and what impact your outgoings have on your borrowing amount, just comment below and we can get an appointment booked in, and check out my page for more hints and tips on what you should and shouldn't be doing when it comes to applying for a mortgage.